There is a quiet crisis spreading through American housing, and it starts with a single number. Today, about 1 in every 13 homes in the United States carries no insurance at all. That's roughly 6 million families, one storm away from losing everything. And by the end, you'll hear the Federal Reserve Chair warn that some of these homes may soon be impossible to insure or to sell. Let's measure the gap. By the most careful national count, about 6.1 million American homes have no coverage whatsoever. That's around 1 in 13 homeowners. And the value sitting there, completely unprotected, comes to roughly $1.6 trillion. An entire layer of American wealth, with no safety net underneath it. For the families who do still have a policy, the bill is climbing fast. Across the country, the average home insurance premium jumped about 24% in just 3 years. And this wasn't a handful of risky places. Prices rose in 95% of all U.S. zip codes. Almost nowhere was spared. Picture the country as 100 neighborhoods. In 95 of them, home insurance got more expensive between 2021 and 2024. This is not a coastal story or a wildfire story. It is a nationwide story. The question is, what could possibly push prices up almost everywhere, all at once? In the hardest-hit states, the numbers stop sounding like insurance and start sounding like rent. In Florida, the average home premium is now about $7,100 a year, the highest in the nation. That's not for a mansion. That's the typical bill, just to keep a roof legally protected. And Florida isn't alone at the top. Line up the most expensive states, and a pattern appears. Louisiana, near $6,000. Then Kansas, Oklahoma, Colorado, Nebraska, all above $4,500 a year. Hurricanes on the coast, hail, and wildfire inland. Wherever nature hits hardest, the premium follows. And here's the twist most people miss. The sharpest increases of 2025 weren't on the coast. Colorado jumped about 18%, Minnesota 17%, Iowa 15%. Hail, wind, and wildfire are pushing the crisis deep into the middle of the country. So to understand the bill, you have to follow the damage. Watch what's been happening to the disasters themselves. This is the engine behind all of it. In 2024, the United States was hit by 27 separate billion-dollar weather disasters. 27 in a single year. Together, they did about $183 billion in damage, making it the fourth costliest year ever recorded. Someone has to pay for all of that, and that someone is the insurer. And 2024 was not a one-off. The very next year brought 23 more billion-dollar disasters, the third highest count ever recorded, and a record year for severe storms. This is no longer a bad year here and there. It's the new baseline. The disasters didn't just get bigger, they got far more frequent. Look at how the spacing has collapsed. Back in the 1980s, the country averaged $1 billion disaster about every 82 days, a few times a year. Over the last decade, that gap fell to about every 19 days. The country now barely finishes cleaning up from one catastrophe before the next one lands. And the bills grew with them. Adjusted for inflation, disaster damage averaged about $22 billion a year in the 1980s. By the 2010s, around $100 billion a year. So far this decade, roughly $150 billion a year. The losses aren't creeping up. They are compounding. And a single storm can rewrite an entire year. In 2024, Hurricane Helene alone caused about $79 billion in damage. Weeks later, Hurricane Milton added another $34 billion. 2 storms, in one season, did more damage than the whole country used to see in a decade. No premium pool is built for that. And here's an unsettling footnote. For 40 years, a federal agency carefully tracked every billion-dollar disaster. After 2024, that official scoreboard was quietly retired. A nonprofit now keeps the count because someone has to. When even the people measuring the damage step back, the insurers are already gone. So what happens when an industry decides a risk is no longer worth taking? It does the only thing a business can. It leaves. Between 2018 and 2023, insurers chose not to renew about 1.9 million home policies. And the rate of those non-renewals has roughly doubled since 2020. Quietly, millions of families have opened a letter that simply says, "We will no longer cover your home." And they aren't leaving at random. They're leaving exactly where the risk lives. The non-renewal rate has doubled since 2020. And of the 50 counties with the highest drop rates, 48 face serious wildfire or flood risk. Insurers aren't fleeing the market. They're fleeing the map's most dangerous corners and pricing the rest accordingly. And this retreat has names you know. In 2023, State Farm, the largest home insurer in America, stopped writing new policies in California. It later dropped about 30,000 existing ones. Allstate and Farmers pulled back too. These aren't fringe players going under. They are the biggest names in the business, stepping back from entire states. And in the most stressed markets, some insurers didn't retreat. They collapsed. In Florida, around 15 home insurers went insolvent since 2020, many crushed by lawsuit costs before reforms arrived. When your insurer goes bankrupt, your protection can vanish overnight, through no fault of your own. So who's left to catch everyone the market drops? The answer is the government, and it's straining. California's insurer of last resort, the FAIR Plan, now covers more than 610,000 homes. Its risk exposure has exploded 424% since 2020 to around $600 billion. And after the 2025 wildfires, it had to bill every other insurer $1 billion, the first time in over 30 years. But here's the hopeful part of the story. Florida went the other way. Its state insurer, Citizens, was carrying over 930,000 policies at the start of 2025. A year later, it had fallen to under 400,000. As private insurers came back, the state was able to hand hundreds of thousands of homes back to the market. So why did Florida improve while California strained? Reform. Florida changed the rules that let lawsuits pile onto claims. Now under 9% of claims end in court. 15 new insurers entered the market. And in 2025, Florida had the smallest premium increase in the entire country, under 0.5%. The crisis, it turns out, can bend. But where the market is breaking, the damage doesn't stop at insurance. It's now reaching the closing table. In 2024, about 1 in 5 home buyers and sellers ran into an insurance problem serious enough to threaten the deal, a quote too high, or no quote at all. The trouble has moved from the mailbox to the moment you try to buy or sell. And the price of risk is now drawn street by street. A Treasury study found that homeowners in the highest risk zip codes pay about 82% more than those in the safest ones. Your premium is no longer about your house. It's about your map coordinates and which side of an invisible risk line you happen to live on. This is what worries the people who watch the whole economy. Asked about it, the chair of the Federal Reserve, Jerome Powell, gave a stark warning. In 10 or 15 years, he said, there are going to be regions of the country where you can't get a mortgage. Not a high premium. No mortgage at all. And that's the chain reaction nobody priced in. No insurance means no mortgage, because lenders require coverage. No mortgage means no sale. And no sale means the value of the home itself can start to fall. A wildfire or a flood never has to reach your street. The insurance map alone can quietly erase the value beneath your feet. But step back, and there's a calmer way to read all of this. Insurance is simply risk, written as a number. When premiums rise in dangerous places, that isn't the system failing. It's the system working, telling the truth about where it's getting riskier to live. The signal is getting louder because the danger is genuinely growing. The alarm is supposed to be uncomfortable. And it's worth remembering, this is not the whole country. In states like New Hampshire, Vermont, and Hawaii, the typical premium is still around $1,000 a year, stable, affordable, and calm. Large, low-disaster markets are doing just fine. The crisis is real, but it's concentrated where the wind, water, and fire actually are. So this isn't the end of home insurance. It's a repricing of risk, playing out one disaster at a time. But the trend is clear, and it's spreading inland. Insurance is the economy's smoke detector, and in a growing slice of America, it has started to scream. The smart move is to listen before the alarm reaches your street. This is descriptive data journalism, not insurance advice. If it was useful, subscribe. A new data story every day.